Hey everyone, welcome back to Corporate Decoder. Today we're diving into Agilent Technology's latest financial report. And let's just say things are getting a little complicated with their new segment reporting. It's like they moved the deck chairs around on the Titanic after it hit the iceberg. But let's see what the numbers actually tell us. Before we jump in, if you love getting clear, no-nonsense breakdowns of corporate filings, make sure you're subscribed. And hey, if you want to chat about this stuff and get more direct insights, our Discord community is linked in the description below. Come join the conversation. Alright, let's look at the core numbers. For the 3 months ending in July 2025, Agilent brought in $7 billion in revenue. That's up 10% from the previous year. For the first 9 months of their fiscal year, revenue hit over $5 billion, a 6% increase. That increased revenue is showing up across all their main business areas and geographic regions, which is generally good news. The product side of the business, which is their bread and butter, saw a 10% jump for the 3 months and a 5% rise for the 9 months compared to last year. They chalk this up to strong performance in certain areas like their contract development and manufacturing, or CDMO business, and their liquid chromatography products. Essentially, they're selling more of the high-tech equipment and related items that scientists and labs need. The services and other part of the business, which includes things like repairs, maintenance, and software, also saw a nice bump, up 11% for the quarter and 9% for the 9 months. This shows that their customers aren't just buying the machines, but they're also relying on Agilent for ongoing support and upkeep, which is often a more stable and predictable revenue stream. Now, here's where it gets a bit tricky. While revenue is up, their gross margin, that's the money left after paying for the cost of making their products and services, has actually dropped. For the quarter, it fell from 54.2% to 51.1%. For the 9 months, it went from 54.2% to 51.1%. For the 9 months, it went from 54.2%, that's a noticeable drop. And they're blaming it on a few things: higher tariffs and shipping costs, a less favorable mix of products being sold, and increased wages. Essentially, it's costing them more to get their products to customers and to keep their operations running smoothly. This dip in gross margin directly impacted their operating margin, which also saw a decline. For the 9-month period, it went from 22.5% down to 20.4%. This means that for every dollar of revenue, they're keeping less profit after covering all their operating costs like research and development and selling general and administrative expenses. As a result, their income from operations actually went down for the 9 months from $1.8 billion to $1.0 billion, even though revenue was higher. This is a class pressures are a significant headwind. Let's talk about their new segment structure. Agilent reorganized in November 2024, and they've recast all their historical numbers to fit. They now have 3 main segments: Life Sciences and Diagnostics segment saw revenue climb 14% for the quarter and 9% for the 9 months. They're seeing strength in pharmaceutical markets thanks to their CDMO business and in diagnostics and clinical areas. The Biosynthesizers and Diagnostics segment saw revenue climb 14% for the quarter and add 4 to 5 percentage points to revenue, have noticing in diagnostics and clinical areas. The Vive revenue climbed 14% for the quarter and 9% for the 9 months. They're seeing strength in pharmaceutical markets thanks to their CDMO business and in diagnostics and clinical areas. The Vive acquisition, which they wrapped up recently, is contributing nicely to this growth, adding about 4 to 5 percentage points to revenue. The Agilent CrossLab segment, which covers their services, consumables, software, and automation solutions, also grew. Revenue was up 8% for the quarter and 5% for the 9 months. They're seeing good performance in pharmaceutical, chemical, and food markets, driven largely by their services and consumables. The Applied Markets segment, which includes things like chromatography and spectroscopy instruments, saw a 7% revenue increase for the quarter, but it was flat for the 9-month period. They're seeing some mixed results here, with strengths in areas like spectroscopy, but weakness in others like their vacuum business and remarketed instruments. Now, a big story in this report is restructuring cost. They've got several plans in place, and the total expense since they started these restructuring efforts is a whopping $196 million. For the 9 months ending July 2025, they incurred $74 million in restructuring costs. This is mainly related to workforce reductions. As of July 31, 2025, they still have a $23 million liability set aside for these restructuring efforts, mostly related to employee severance. This shows they are actively working to reshape their operations, which often involves significant upfront costs for future savings. Specifically for their fiscal year 2025 plan, they recorded $73 million in costs, with a significant chunk of that, $56 million, hitting in the first 9 months of the year. This plan is aimed at optimizing their management structure. It's all about trying to become more efficient, but these programs create short-term pain for potential long-term gain. Looking at the bottom line, net income for the 9 months declined to $869 million last year, despite the revenue growth. This is a direct consequence of those rising costs we talked about earlier and the impact of these restructuring charges. Diluted earnings per share also saw a dip from 3 tonses last year to 3 centi last year to $3 this time around. When we look at cash flow, cash provided by operating activities was $1.01 billion for the 2025, down from $1.27 billion last year. Several factors contributed to this. They used more cash for accounts receivable, meaning it took longer for customers to pay them. Inventory also consumed more cash, even though they reduced the number of days inventory is on hand. This suggests they're holding more valuable inventory. In terms of investing activities, Agilent spent $314 million on property, plant, and equipment in the first 9 months of 2025, up from $285 million for the full year, largely to expand their manufacturing capacity for nucleic acid-based therapeutics. That's a significant investment in future growth. Financing activities saw them spend $340 million on repurchasing their own stock in the first 9 months of 2025, compared to $815 million in the same period last year. They also paid out $212 million in dividends this year, up from $206 million last year. This indicates a continued focus on returning value to shareholders, though at a slower pace for buybacks. Now let's touch on the risks. Agilent is clearly worried about a few things. General economic conditions, including inflation and interest rates, could hurt demand for their products. They're also keenly aware of the impact of tariffs and trade policies, which have already affected their costs. Competition is fierce and they need to keep innovating to stay ahead. And as always, dependence on key personnel and managing global operations are constant challenges. They're also highlighting risks related to artificial intelligence, which is smart given how rapidly that technology is evolving. There's also this interesting point about evolving stakeholder expectations around corporate governance and sustainability. It means companies like Agilent need to constantly adapt not just to financial pressures, but also to changing social and environmental demands. Failure to do so can bring its own set of risks. So what's my take? Agilent is showing revenue growth, which is a positive sign thanks to strong product demand and the integration of new acquisitions like Bevctor. However, the declining margins and income from operations are a clear concern. They're grappling with rising costs and the impact of restructuring, which, while potentially beneficial long-term, weigh on current results. It looks like a company in transition, investing heavily in growth areas and efficiency initiatives, but facing headwinds that are squeezing profitability. They're navigating a complex business environment with global economic uncertainties, trade policy shifts, and the ever-present need for innovation. What do you think about Agilent's performance and their strategy? Does the revenue growth outweigh the margin pressure and restructuring costs? Let me know your thoughts in the comments below. And if you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate filings. Don't forget to join our Discord community too. It's linked in the description. Thanks for watching, and I'll see you in the next one.